basic purpose of organizing a corporation is to earn profit, and by doing so, it needs to operate in order to generate income. In this tutorial, we will discuss about how companies operate internally and externally. A corporation's owner's equity section is known as the shareholder's equity. There are three things that must be under the shareholder's equity section, namely the contributed capital and the retained earnings. The contributed capital is composed of two parts. First is the share capital. This section reports both preference and ordinary share capital issued, subscribed, and distributable as dividends, stated at par or stated value.
There are 5 things that must be included in this particular section: class of the share, par or stated value, authorized shares, number of issued shares, dividend rights in case of preference share capital.
Note that share capital subscription receivables that are not currently collectible are shown as deduction from share capital subscribed. The second and last part under contributed capital is the additional paid-in capital. This section reports investments by shareholders in excess of the par or stated value of the share capital. In short, it includes the share premiums of both classes of share capital. The last component of the shareholders' equity section is the retained earnings. This component represents the undistributed earnings of the corporation. It consists also of two parts, the appropriated and the unappropriated retained earnings. The only difference that sets these two apart is that the appropriated retained earnings, as the term itself says, is set aside for a specific purpose other than for distribution as dividends, while the other is its opposite and is available for distribution as dividends. Now, let us discuss about the different kinds of dividends and what it is about. Date of declaration: this the date when the BOD approved the resolution to distribute dividends. The liability of the corporation to the shareholders are recorded on this date. Date of shareholders of record: this is the date when the company determines the shareholders entitled to the receipt of declared dividends. There is no entry recorded under this date. Date of distribution: this is the date when dividends declared are distributed to the shareholders. The liability previously recognized on the date of declaration is extinguished.
Let us now start with cash dividends. These are dividends distributable in the form of cash and is the most common type of dividend.
On the date of declaration, we debit retained earnings and credit cash dividends payable. On the date of distribution, we debit cash dividends payable and credit cash.
Next is the scrip dividends. These are, in fact, deferred cash dividends. It consists of a written promise to pay certain amounts at a future date. The payment normally includes the principal amount plus the interest at a specified date. To further understand this, we must know that scrip dividends are declared when the corporation has sufficient retained earnings balance but not sufficient funds at that time for cash dividends.
Here are the entries when we record at the date of declaration and when we record at the date of distribution.
Now we have the property dividends. When distributing this dividend, the fair market value of the asset is to be followed and the recorded amount must always be equal to its fair market value. This means that every time the fair market value of the asset changes, the amount recorded must be adjusted accordingly.
To record the declaration and settlement of dividends, here are the entires.
Lastly, we have the share dividends. This is a distribution to shareholders in the form of the corporation's own share capital. Note that this type of dividend does not affect total assets and total shareholders' equity. Rather, it simply represents a transfer of capital from retained earnings to contributed capital. Hence, the total shareholders' equity, before and after declaration and distribution of dividends are the same. In recording this, a distinction should be made between a small and large share dividend. If it's less than 20% of the outstanding shares, then it is considered a small share dividend. And when it is equivalent to 20% or more, it is considered a large share dividend. Under the small share dividend, retained earnings is debited for the fair value of the share capital, while, under the large share dividend, it is the par or stated value that is debited to the RE.
To record the small share dividend, we will have these entries. To record the large share dividend, we will have these entries.
When dividends are paid, the dividend requirements on preference shares must be paid before any payment can be made to ordinary shareholders. The required dividends depend upon the type of preference preference shares issued by the corporation. Cumulative where preference shareholders are entitled to the payment of past year's unpaid dividends or dividends in arrears before the payment of the current year's dividends.
Non-cumulative, where preference shareholders are not entitled to the payment of dividends in arrears. They are entitled to the current year's dividends only.
Participating, where preference shareholders are entitled to additional dividends after the payment of regular dividends to both the preference and ordinary shareholders. There are two classes of allocation when a preference shareholder is fully participating. The excess dividend is allocated proportionately to the two classes of share capital based on PV. However, it is up to a certain percentage only. A comparison should be made between the maximum allowed participation and the amount of the full participation. The given to the preference shareholder as the lower amount between the two.
And lastly, non-participating preference shareholder are both entitled to any dividend in excess of the regular rate. The entire dividend balance after the preference shareholders get their regular dividend rate is given to the ordinary shareholder.
To further understand the different types of preference shares, here are 4 possible cases.
Since the preference shares are non-cumulative, the dividends in arrears are ignored and the shareholders are entitled to the current year's dividend only. And also, since it is non-participating, the shareholders is not entitled to any dividend in excess. All the excess are given to the ordinary shareholder. Since the preference shareholder is cumulative, they are entitled to the payment of dividends in arrears. And since they are non-participating, they are not entitled to any dividend in excess of the current year's dividends. Since they are non-cumulative, they are only entitled to the current year's dividends, and since they are fully participating, they are entitled to additional dividends after payment of regular dividends to both preference and ordinary shareholders. Since the preference share is both cumulative and fully participating, they are entitled to the receipt of dividends in arrears and also to the receipt of additional dividends after payment of regular dividends to both preference and ordinary shareholders. Additional dividends after payment of regular dividends to both preference and ordinary shareholder. Book value per share is the peso equity and corporate capital of each share of stock. It is the amount that a shareholder would receive for every share owned in case of corporate liquidation. Earnings per share is the amount earned during a given period on each ordinary share outstanding. To compute net income over number of outstanding shares,